Hi, and welcome back to the Business Career College video series. We're now into part 6 of our video series around the multi-year cash flow. And now we're going to start some accumulation. And this is going to have a fair bit of complexity to it, as you might expect. So I know I'm going to accumulate in certain areas. I'm going to have Jeff's RRSP. I might have Tina's RRSP. Maybe I've got Jeff's TFSA and Tina's TFSA. And maybe I've got Jeff's non-reg savings and Tina's non-reg savings. Okay, and let's go with that. I'm going to shrink this formula bar again. All right, so now for Jeff's RRSP, as you probably expect, I'm going to make a sheet here. And we're just going to bring that back over. Tuck those line of credits away, and we've got our RRSPs, and we're going to do the same thing as we've done. We're going to make these top rows equal to our multi-year cash flow amounts, or multi-year cash flow values, so that we've got everything all the same. And just copy that all the way across. So we know we're dealing with an RRSP. And because of that, we have some particular considerations here. So what do we do around the RRSP? Well, the first thing is we have to concern ourselves with the contribution limit. So I can look at Jeff's gross income, which is going to determine the contribution limit. So we're going to take Jeff's gross income off of our income sheet that we had back here. And we can assume that's going to be inflated. And in fact, we've already made that assumption. So we're going to do Jeff's gross income times 1 plus our inflation number. And I'm probably going to move my data sheet over here because I'm going to need to refer to it a fair bit. We're going to make that an absolute reference. And we're also going to make our... Oh, no, that's good. Just like that. And of course, these should all be dollar amounts. And I want to show something here. This is all just one step at a time stuff. It's not that I have to have had all of this planned out well in advance, and you're going to end up sort of doing things differently depending on the particular set of circumstances sometimes. So really got to work through this. So now we got Jeff's gross income calculated all the way out. And now we can do something like this, where we're going to look at Jeff's new deduction limit for the year. And we might even do the maximum deduction limit. So the maximum deduction limit for 2016 is $25,370. And probably safe to assume again, in fact, this is legislated, so it's not just an assumption, that that's going to increase with inflation. So we can see that max deduction limit increasing all the way across here with inflation. So we know Jeff's new deduction limit is going to be the smaller of either this amount times 18% or the actual deduction limit. Of course, he's never going to run into that problem as long as both of those things are absolutely, truly inflationary. No issues, but at least that way we can see that we've properly taken that into account. And Excel, again, is giving me that little warning that this formula doesn't look like the formula above or below it. Not a big deal. So I can see his new deduction limit growing like so. Okay, and we're going to come back to that concept in a couple minutes. So now we actually want to be putting some money into Jeff's RRSP. So how do we get to that? Well, we'll go back to our multi-year cash flow. And now we might spell out that this is going to be Jeff's RRSP contributions. So Jeff would only be making RRSP contributions, presumably, if he can afford to do so. Now we're going to have to make a decision about the extent to which we're going to contribute to Jeff's RRSP or Tina's RRSP, and maybe the way that we're going to do this is we're first going to designate an amount available for savings. So I'm going to insert a row here, and we're going to allocate an amount for savings. And fairly straightforward here, we have an amount of net income minus a bunch of expenses. So these would all be our set of expenses. And it should be, oh yeah, you know what this reminds me we forgot to do was take out the other $2,700 out of the line of credit payment. So really what I've done here is I took the $2,700 and we sort of assumed that that was going towards the line of credit. We're going to take that right out of there. And we're going to see if that fixes things. And it looks like we're a little bit better off here, but I can see right here that I left Tina's credit card payments out of part of that equation. So now we have to go through and we have to run that line of credit payment all the way back across. That wasn't that bad an error. So now we've sort of slowed down the rate of paying down the line of credit. That's okay. So essentially what I did is I took the $2,700 out of the equation. I just said we're going to take the total surplus amount and pay down the line of credit. Okay. Now we could have done things differently. What we could have done is somewhere in here we could have had a fixed savings amount, and that would have changed things a little bit. If we know we're already on a monthly pack, for example, then that might make less available to pay down the line of credit. So whatever it is here, we've done sequentially the line of credit last, but let's in fact do that. Let's say, you know what, actually, they do put some money every month into savings. So we're just going to insert a row here, and we're going to put a savings amount. And let's say that right now they happen to be saving between the two of them $2,000 a year. So Excel's pretty smart. It actually adds that into the sums that we already have. So we know we're putting away $2,000 a year. That's already the case. Now that might be inflationary. And if it is going to be inflationary, then maybe I just take the same formula and I copy that down. And again, just one problem at a time here. Now I say, well, you know what, it's kind of weird actually. You probably wouldn't have your savings amount inflated exactly to inflation. What's more likely is that maybe periodically we adjust it when inflation justifies it. So this is where I might pop over and start using the amounts saved sheet that we haven't yet used. And again, we're going to do what we've been doing all along here and just go copy that over. And copy those amounts over. And just do our freeze panes again here, as we've always been doing. And we might say, all right, what's the actual amount saved, the fixed savings, or whatever we want to call that. And we're going to start at 2,000 here. But we want to adjust that for inflation. I apologize, we want to adjust that for inflation. So now we're going to do as we've done. We take the previous year's amount times 1 plus our inflation number, 2%. We're going to put our absolute reference in there. Make that look like the same type of value. And we can just copy that out all the way across. But this is where I say, well, hang on a second. I actually would like to have that adjust to inflation, or sorry, have that adjust so that it only increases when it makes sense to do so. So this is where I can use a function that Excel has that's kind of neat called mround. And what mround is going to do is it's going to round that number off to the nearest sort of logical number. Now, if I mround this, it's not going to inflate properly. So really, what I want to do is I say the real amount, or when I take inflation into account, I'm going to take that value up above, and I'm going to round that off. So I'm going to take mround, and I'm going to round that to the nearest $500 increment. Okay, or I could do it to $1,000. We'll do $500. So we'll see what happens here. Is that now we should get that amount just increasing in nice, clean $500 increments, which is probably more realistic. So now we pop back to our multi-year cash flow sheet. Instead of using that $2,000 now, I'm just going to base that back on that amount saved. I'm going to adjust that accordingly. And we say, all right, our savings amount. And now we should see it just step up by $500 increments. Good to go. And so now, when we look at our amount available for saving, we say we're going to take, or we might call that our, we're going to include. What we'll do here is we'll just use that comment function again, and we'll put in a comment that this is going to include our savings amounts. And so now we're going to look at all the income here minus our expenses, and we're not going to use the sum function here because I don't want to drag my savings amounts into that. So I'm going to do this a little bit more tediously. So now the amount for savings here is going to be the net income minus all those other expenses. Okay, and we've got the $2,000 that's left here because we didn't carve that out. Now, maybe what I do, so we're just going to copy that formula across. It does work out properly here where the formula that I've used, essentially we're ignoring the savings, or it sort of gets added back in, however you want to look at it. And we can copy that all the way across and see how much you're able to save each year. So now we've figured out what's available for savings. In the next video, we're going to start allocating some of those savings dollars out.